about the definition of short-term financing and its uses. Short-term finance refers to financing needs for a small period, normally less than a year. In businesses, it is also known as working capital financing. This type of financing is normally needed because of lack flow of cash into the business. In most cases, it is used to finance all types of inventory, account receivables, and others. Short-term financing can strongly help if you are a small business owner facing a temporary cash flow problem. There are 5 situations in which a small-term business can use short-term financing. The first one is to start up the cost. Short-term financing can be granted to both new and existing businesses. Therefore, a promising entrepreneur can finance the start-up cost of their business by obtaining a short-term financing. This is particularly helpful if you simply don't have the cash to finance this cost yourself and to boost your business. Second, account receivable versus payables. Many businesses are cyclical in nature, and there is often a gap between account receivables, which is cash coming in, and account payable, which is cash going out. If you know this is a temporary situation and your receivable will be coming in quickly, a short-term financing will help you bridge the gap without falling behind in your bills. For the third situation is the short-term operational cost. A short-term financing can cover any short-term operational costs that you may have. For example, if you need to hire extra staff during a seasonal push, a short-term finance can finance your needs so you can get the job done. Fourth, it is for emergency repairs and maintenance. A short-term financing can help you make it through an emergency situation. For example, if your computer crashes and you cannot run your business without it, a short-term finance loan can finance the repair. Last but not least is the cash flow. Short-term financing have a short periods than regular loans, which makes them ideal for any temporary cash flow situation. If you don't have the money now, but you can depend upon money coming in within a certain period of time, a short-term financing would be a good way to fill the need.
Now I'm going to present about the advantages and disadvantages of short-term financing. The first advantage is it is easier to obtain. Short-term financing can be more easily obtained than long-term financing. A firm with poor credit standing may be unable to obtain long-term funds. The short-term creditors, while granting loan, assume less risk than long-term creditors because there is a less chances of substantial change in the financial soundness of the creditors within short-term period. Secondly, short-term financing is flexible than long-term financing. Due to seasonal nature of business, many firms have a temporary demand for short-term funds to carry heavier inventories. Short-term financing is flexible in the sense that the firm is able to secure funds as they are needed and repay them as soon as the need vanishes. The long-term financing is secured to finance the daily or weekly or seasonal variation. It will become inflexible because long-term funds cannot be repaid as soon as the need for funds vanish. Lastly, it can improve company credit rating. All businesses have a credit rating. By taking out loans and the lines of credit, short-term financing helps to build the company credit history. Of course, the company will have to repay this on time to ensure their credit rating is on point. Now, the great thing about short-term loans is that they give your credit score a boost. They can be helpful in getting longer-term loans and bigger lines of credit in the future. Small businesses oftentimes struggle with obtaining this because of the lack of good credit. Then, once the company repays their short-term loan, they can reapply in the future and possibly get a larger line of credit. Next is the disadvantages of the short-term financing. First, short-term financing have frequent maturity. Short-term financing is the advantageous in the sense that it matures frequently. The principal must be repaid when due, otherwise the creditor may close the business. The use of such credit is also a risk to the owner's investment from the inability to meet the creditor claims when due. There may be dangers of either meeting the principal payment or at maturity of the loan or meeting any periodic interest payment or both. Secondly, it is high cost. The rate of interest paid on short term is usually higher than long-term financing. The rate of interest usually depends on the risk involved, the size of loan, collateral, protection, and other factors. Last but not least, it opens a cycle of repeated borrowing. As the application process is quick and you get the financing immediately, short-term financing is a quick solution that may be too easy if you get used to it, and you may fall into a cycle of repeated borrowing. If you take out short-term loan this month to pay suppliers and take out another one next year to repay your employees, this is a sign that your business isn't operating efficiently.
Good day everyone, I'm Punida. Now I'm going to present about the sources of short-term financing. Sources of short-term financing is that from financing which embrace borrowing and lending of finance for the short-term period. Following are the sources of short-term financing, which is trade creditor. Trade creditor are those business established with sales goods to other on trader. Second thing is customer advancer. Customer advancer, customer often seller to finance seller to through the advance payment for the goods. The price of the goods to be purchased are paid or advanced before the good is received to the customer. Third thing is personal loan of company. Personal loan company, this company make loan for the individual generally for the personal consumption. Commercial bank. Commercial bank of the economy is generally supply funds to the business in concern of short-term period, either with security or without security if the customer is financially established. Commercial paper house. They are specialized in financial agency and created promissory notes to sell other investors who have desired to liquidity some of shortage liquidity. Factor and broker. Factoring is based on different philosophy considering the company request for the fund. We all more interest the company ability and future inspiration for us. Last but not least, the miscellaneous sources. There are many more sources which secure for the short-term fund. It could be family and relative, public deposit, company director, and foreign exchange bank. Thank you.
Hello guys, my name is Zhou Wenchen. I'm talking about types of short-term financing. First, I'm talking about commercial paper. This is an unsecured and discount accept notes that is issued to a large number of institutional investors for short-term loans. This is usually issued by companies with high credit ratings. Because of this, commercial paper is often a low-risk investment. So why it's important? The main investor in commercial paper including money market mutual funds and the commercial paper trust departments. These large institutional investors tend to prefer the close saving inherent using commercial paper rather than traditional bank loans. I'm talking about repurchase agreement. It's also called repo. The repo is assumed self-security and repo at higher price for the same security at some point in the future. This is usually a short-term transaction, mostly with an overnight extension. Although it's somewhat extended for short-term repurchase, the risk is very low. So why it is important? The repo has evolved into a large part of money market, driving the growth of short-term market for mutual funds that trade government-backed securities. Third, I'm talking about installment loan. This is a type of loan that is repaid in principal and interest on regular basis, usually monthly payments. So why it is important? They are ideal for the business and individuals who lack of cash to buy large items or service. They are convenient way to pay building, home, car, or college tuition in a manageable regular installment. After the installment loan, the borrower interest obligation is periodically accumulated at a specific interest rate. If there are no payments, the interest will only accumulate and the borrower is required to pay the higher total loan amount. Thank you.
Which type of short-term finance is appropriate for SMEs? 5 points. The first one is a reasonable amount of capital. For large enterprises, the purpose of financing is to achieve the best capital structure. That is the lowest cost of capital and the highest enterprise value. For small and medium-sized enterprises, the purpose of financing is to ensure the funds needed for production and operation. The second one is effective use of funds. Due to the weak anti-risk ability, need to consider comprehensive management and the cost of capital, financing risk, return on investment, and many other factors. The third one is reasonable proportion of capital structure. Pay attention to the matching relationship between financing and investment in capital structure. The fourth one is the operation of funds to pursue incremental financing while paying attention to stock financing. The last one is financing methods to choose the most conducive to improving competitiveness of enterprises. What is the best and most viable option of short-term finance for an organization? The first one is when raising funds, the enterprise should determine the financing scale of the enterprise according to their needs for capital. The second one is selected the best financing opportunities enterprise. Financing decision must be predictable in advance. The enterprise to be able to timely certain the domestic and foreign interest rates, exchange rates, and other financial market information. The third one is reduce the financing cost. When choosing bank financing, we should pay attention to the different credit policies, then choose the best one. The first one is making the optimal financing term decision and how to choose, depend on the purpose of financing and the risk preference of the financer. What is the importance about bills of exchange in short-term financing? The answer is bill of exchange has a variety of functions. Bills of exchange can convey monetary policy, intention to the real economy, and implement structural adjustment. The development of bills of exchange in short-term financing has guided the capital flow financial institutions. They can help to solve the financing difficulties of enterprises and improving the asset quality. And then, bill of exchange play an important role in social and economic activities. Makes the form of credit bill, credit standard, and help to strengthen macro control and perfect the function of bill market. Bills of exchange market improve the socialist market economic system to promote seller sales of the enterprise, reduce the buyer cost. In addition, it can make up for the shortage of credit and prevent the debates.